Hey, Judy, Peter, guess what? I own Investorcom.
What do you mean you own Investorcom? They are one of the largest financial institutions in Kenya.
With my savings, my mother bought for me Investorcom, so I own it now.
Well, Wasi, technically you are correct. However, you own part of Investorcom. There are a number of shareholders who own Investorcom, so as it turns out, your ownership may only be 0.000001%.
But you're saying I still own it, right? I'm going to be rich. Yeah, I'm going to be rich.
Wasi, I'm confident you'll be rich. But have you ever wondered how the rich got their wealth and then kept it growing?
Of course I do. Tell me more.
Investing money early in life is a way to grow your wealth over time. The earlier it is invested, the more time the money has to grow.
In addition to buying stocks, there are other ways to increase your wealth and a number of things to consider. Let's learn more about investing to help you build your wealth.
Woohoo! I'm going to be rolling in dough pares every weekend at the coast, Maze.
There are only two ways to make money: by working and/or by having your money work for you. Your parents will often tell you that you can earn only by getting a job, and that's what many of us do. However, there's a limit to the number of hours you can actually work. So rather than working more hours, you need to make your money work for you. By investing your money, you're getting your money to generate more money by earning interest on what you put away or by buying and selling assets that increase in value. The Kenyan financial markets offer an array of investment products. The type of products chosen by the investor to commit his or her capital depends largely on his or her financial goals, time frame, and the amount of capital available. First, let's understand how the Kenyan government is safeguarding the capital markets. The Capital Markets Authority, CMA for short, is charged with the responsibility of supervising, licensing, and monitoring the activities of market intermediaries, including the Securities Exchange and the Central Depositories and Settlements Corporation, CDSC, and all the other persons licensed under the Capital Markets Act. The functions of the CMA are to license and supervise all the capital market intermediaries, ensure proper conduct of all licensed persons and market institutions, regulate the issuance of capital market products, promote market development through research in new products and institutions, promote investor education and public awareness, protect investors' interests. Visit www.cma.or.ke to learn more about the Capital Markets Authority. Although there are laws and guidelines to protect investors, it is ultimately the investor's responsibility to evaluate the suitability, profitability, and viability of an investment. There are many ways to invest. You can put your money into stocks, bonds, commodities such as precious metals, oil and agriculture, collectibles such as art, coins and stamps, real estate, or even start a business. We'll call these general categories asset classes. An asset class is a group of investments that has similar characteristics and are subject to similar market forces, laws, and regulations. The collection of an individual's financial assets is referred to as his or her portfolio. Although there are a number of asset classes, most investment managers agree that the three main asset classes are stocks, also called equities or shares, bonds, also called fixed income, and cash and cash equivalents. A stock, also called equities or shares, is a share in the ownership of a company. When you buy a share, you become an investor and thereby an owner of a piece of the company's profit or loss. Depending on the company, it may have thousands or even millions of shares. Companies often sell shares to raise money from members of the public to expand its business. Shares are traded on a stock exchange or market. It serves as the link between buyers and sellers. Kenya has its own stock exchange, the Nairobi Securities Exchange, NSE for short. After you purchase shares, the price can fluctuate. If the demand for the share increases, the price for that share increases. And if the demand decreases, the price for that share decreases. Still confused? Think about it this way. The stock market is similar to a regular market. If more people want apples, with the supply of apples unchanged, the grocer will likely increase the price to make more money. However, if people no longer want apples, with the supply of apples unchanged, the grocer will try to reduce the price to sell his apples. Let's review an example. Suppose the price of an Investicom share is 500 shillings. Therefore, with 50,000 shillings, you can buy 100 shares. 20 days later, the price of an Investicom share jumped to 600 shillings because the company announced strong turnover and profits. If you sold your 100 shares after the announcement, you would have made 10,000 shillings in profits. Remember, the more money a company makes, the stronger the demand for the share. Let's review how to read a stock chart, which can be found in the newspaper. Company name. This column lists the name of the company. Last 12 months high and low. This is the highest and the lowest price at which a share has traded over the last 12 months. YTD percentage, or year-to-date percentage. The percent change in the current price of the share from the beginning of the year. For example, if the share price today is 495 shillings and the price on January 1st of the current year was 450 shillings, the YTD percent is 10%. VWA last price, or volume weighted average last price. The last traded price recorded when the market closed on the day. VWA previous price, or volume weighted average previous price. The last traded price recorded when the market closed on the previous day. Daily price change. The percentage price increase or decrease from the previous day. Daily traded shares. The amount a particular stock has traded that day. MKT, cap, shillings, MN. Market capitalization, Kenya shillings, millions. Market capitalization is the total value of the issued shares of a publicly traded company. It is equal to the shared price times the number of issued shares outstanding. EPS last 12 months, or earnings per share last 12 months. Earnings per share serves as an indicator of a company's profitability. It is calculated by dividing the company's profit less dividends by the number of shares issued. For example, if Investicom has 5.25 billion shillings of profit over the past 12 months and issued 1.2 billion shillings in dividends over the same period, and the company has 225 million shares outstanding, the company's earnings per share will be 18. PE, or price to earnings ratio. The company's current share price compared to its last 12 months EPS. For example, if a company is currently trading at 495 shillings a share and earnings over the last 12 months were 18 shillings per share, the PE ratio for the stock would be 27.5. Total dividend yield. Calculated as annual dividends per share divided by price per share. Remember, a dividend is a payment made by a corporation to its shareholders, usually as a distribution of profits. For instance, if a company paid an annual dividend of 5.33 shillings per share, and the company's stock is traded at 495 shillings, the dividend yield would be 1.08%. Dividend yield is a great way to measure how much cash flow you are getting for each shilling invested in a share. Financial professionals advise that beginning investors not actually start investing in individual stocks. If you own just a few stocks, it is more likely that you'll see a sharp, sudden change in the value of your investment. However, we have provided a few tips on selecting individual stocks. Avoid the hype. Look at the company's performance. Buy what you know. You know why you chose to buy your favorite brands. That may help you better understand a company's performance. Consider price and valuation. Investment professionals often look for stocks that are cheap or undervalued. Generally, this is measured by the stock's price to earnings ratio, or PE ratio. A PE ratio is the company's current share price compared to its earning per share. A company that's expecting to grow rapidly will be more expensive than an established company that's growing more slowly. Compare a company's PE to other companies in the same industry to see if it's cheaper or more expensive than its competitors. A stock may be cheap because its business is slowing down. Evaluate financial health. Analyze a company's turnover, also referred to as a company's sales or revenue, and profitability. Find a dividend. A dividend, a cash payout to shareholders, is a sign of a company in good financial health. Ensure the company abides by local rules, regulations, and laws, and is respectful to its shareholders. What not to do when buying a stock. Don't buy on price alone. Don't assume a stock is a bargain just because its price has dipped 10%. Don't forget to sell. Having a plan for selling will help you avoid selling out of panic over a short-term move in the market. Liquidity is the ease at which an asset can be easily bought or sold. Liquid assets, such as stocks, reduce some risks by ensuring that an investor will be able to quickly react to market movements. A young family may prefer liquid assets because they allow them to convert them to cash on an as-needed basis. You may have heard the terms bull and bear market to describe the stock market. The most important thing to know about these terms is that they describe long-term trends, not short-term changes. A bull market is a rising market. In a bull market, investors are positive. The economy tends to be strong, unemployment is low, consumers are spending money, which increases business profits, which often leads to rising share prices. Investors tend to take risks because they feel good about their chances of making money. On the other hand, a bear market is a declining market. In a bear market, the economy tends to be weak, unemployment is high, consumers spend less, which results in lower business profits and often leads to falling share prices. Investors tend to sell their stocks before the value decreases too much. Bonds may not be as glamorous as stocks, but provide a steady return and tend to be a significant component of most investment portfolios. A bond represents loans made by investors to companies and other entities, such as branches of government. Bondholders do not share in the company's profits. Rather, they receive a fixed return on their investment. Bonds are issued for specific time periods. When the bond expires and the principal is returned, the bond is said to have matured. Bonds can take as long as 30 years to mature. Keep in mind, a bond can be sold before maturity without penalty. As with every investment, bonds carry the risk that a promised payment will not be made in full or on time. As uncertainty of repayment rises, investors demand higher levels of interest in exchange for assuming greater risks. Investors can look to a company's or government's creditworthiness to better understand the risks associated with the investment. Creditworthiness is an assessment of the likelihood that a borrower will default on their debt obligations. The creditworthiness is usually based on the entity's credit history, credit rating, and character. The Kenyan government, as well as corporations, issue bonds to fund their day-to-day operations or to finance specific projects. Remember, when you buy a bond, you are loaning your money for a certain period of time to the issuer, in this case, the Kenyan government. In exchange, the borrower promises to pay your interest every year and to return your principal at maturity. A bond's face value, or price at issue, is known as its par value. Its interest payment is known as its coupon. Let's review an example. Suppose you purchase a 100,000 shilling bond, paying a coupon rate of 10% a year, or a 10,000 shilling coupon. If you buy the bond for 100,000 shillings and hold it to maturity, the yield, or actual return on your investment, is also 10%. The prices of bonds fluctuate throughout the trading day, as of course do their yields, but the coupon payments stay the same. Suppose you don't buy the bond right at the offering, and instead buy from someone else in the secondary market. If you buy the bond for 120,000 shillings in the secondary market, though, the coupon will still be 10,000 shillings. But the yield is now 8.3% because you paid a premium for the bond. you pay 20,000 shillings more than its face value for the bond. For a similar reason, if you buy the bond for 80,000 shillings, its yield will be 12.5% because you bought the bond at a discount. Cash and cash equivalents. These are typically savings, call, and fixed deposits, and are the safest investments, but offer the lowest return of the three major asset categories. The chances of losing money on an investment in this asset category are generally extremely low. Pros. Stocks have traditionally outperformed every other asset class and are capable of outperforming inflation. The longer you hold stocks, the better your chance of achieving your financial goal. The reward is high. Cons. Severe losses can occur at any time and frequently do. You could easily lose 30% of your capital in a single year. Furthermore, the highs and the lows of share ownership can feed all kinds of irrational behavior, from panic selling in the face of loss to piling into a bubble market. The risks are high. Bonds. Pros. Bonds are much less volatile than stocks. Furthermore, they provided a better return than cash. The risk is moderate and reward is generally reliable. Cons. Bond returns typically lag stocks and they are vulnerable to inflation and changes in interest rates. Cash and cash equivalents. Pros. You can't suffer a capital loss and it's liquid like water. If you lose your job and need money for food or rent, your cash reserve can quickly be converted to satisfy your needs. The risk is low. Cons. Over time, cash and cash equivalents will not keep up with inflation. Furthermore, historically, cash and cash equivalents have earned the lowest return of the major asset classes. The reward is low. In Kenya, unit trusts are the small investor's answer to achieving wide investment diversification without the need of large sums of money. A unit trust fund is an investment scheme that pools money together from many investors to be managed by professional managers who invest the pooled money in a portfolio made up of a variety of asset classes. Remember, in a unit trust, each investor owns shares, which represent a portion of the holdings in the unit trust. Keep in mind, only unit trust schemes that are approved by the Capital Markets Authority may be offered for sale to the Kenyan public. An approved fund can easily be identified by the cover of its prospectus that contains a statement that a copy of the prospectus has been logged and approved with the Capital Markets Authority. Some of the advantages of unit trusts are professional management. A unit trust is a relatively inexpensive way for a small investor to get a full-time manager to make and monitor investments. Diversification. By owning shares in a unit trust instead of owning individual stocks or bonds, your risk is spread out. Economies of scale. Because a unit trust buys and sells large amounts of securities at a time, its transaction costs are lower than what an individual would pay for securities transactions. Liquidity. A unit trust allows you to request that your shares be converted into cash at any time. Although there are a number of advantages to unit trusts, there are some disadvantages that you should be aware of. Professional management costs. Regardless of how the unit trust performs, the manager of the trust still gets paid. Dilution. Because trusts have small holdings in so many different companies, high returns from a few investments often don't make much difference on the overall return. The process of determining which mix of assets to hold in your portfolio is a very personal one. The asset allocation that works best for you at any given point in your life may depend largely on your time horizon and your ability to tolerate risk. Time horizon. Your time horizon is the expected number of months, years, or decades you will be investing to achieve a particular financial goal. An investor with a longer time horizon may feel more comfortable taking on a riskier investment because he or she can wait out the ups and downs of the markets. By contrast, an elderly couple may take on less risk because they have a shorter time horizon. Risk tolerance. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. An aggressive investor, or one with a high risk tolerance, is more likely to risk losing money in order to get better returns. A conservative investor, or one with a low risk tolerance, tends to favor investments that will preserve his or her original investment. You can easily buy stocks and bonds on the Nairobi Securities Exchange, or NSE for short, the leading securities exchange in East Africa. The NSE is licensed and regulated by the Capital Markets Authority. To begin buying and selling on the NSE, you'll need to first open a central depository system, CDS for short, account with the stockbroker or an investment bank. Visit the NSE's website, www.nsc.co.ke, to obtain a list of members which are licensed to buy and sell shares. A stockbroker is a firm that charges a fee or commission for executing buy and sell orders submitted by an investor. People like you and me cannot just go into a securities exchange and buy and sell shares. The Central Depository and Settlements Corporation, CDSC for short, was created to provide a centralized system for the transfer and registration of securities in electronic format. Investors no longer have to deal with actual physical certificates and all the risks and inefficiencies that come with them. Next, deposit a sum of money you intend to use to purchase shares in your stockbroker's account, which is then credited to your trading account with the stockbroker. Remember, the securities you purchase will be held in your CDS account. Do your homework. As we mentioned earlier, it's critical that you research the stocks and bonds you wish to purchase. When you're ready, place an order with your stockbroker to purchase a security. Once you've bought the shares, you can only sell them 3 days after the purchase. The NSE operates on a T+3 day system. In other words, investors who sell their shares will get their money 3 days after the sale.
Judy and Peter, thanks so much for helping me become financially savvy. With your advice, I know I'll become big one day.
No problem, Wasi.
We're just glad we could help.
Hey, Peter, Judy, thanks so much for all the financial literacy advice. I've built my empire and I'm rolling, Maze.